the theory part of it. Options. Now, what is options? Explain in the simplest of terms. Options really is just a contract between two parties, the usual two parties. You have the buyer, the seller, and the contract was spell out what is the underlying instrument, what is the instrument that is being traded. That means to say, if you're we are I'm going to be talking about options in relation to stock, so it's a stock option. Options can be written on practically anything, and you can write options on futures, you can write options on commodities, you can write options on indexes, so on. But for the purpose of today's sharing, it is my focus will be on stock options or ETF options, so index options. So options is merely a piece of contract between a buyer and a seller that spells out what is the underlying instrument. Means if you're talking about an Apple stock option, where the underlying instrument will be the Apple stocks, the shares of the Apple company. So if you're the buyer, it spells out what is the price you have to pay to enter this contract, when must this contract be fulfilled, and what is your right as a buyer to, if you enter into this contract, it could spell out that it gives you the right to buy the 100 Apple shares, for example, 30 days from today at this particular price, at this particular strike price. So option explained in the most simple form is just this: a contract between two parties, a buyer, a seller, that spells out the price and the time that the contract must be fulfilled. So if options, two types of options: a call option and a put option. So if you cannot remember what is a call, what is a put, just use the symbol that I've used here, the image. Call options are typically associated with bullishness, because a call option the definition of call option is that it gives you the right to buy shares of an underlying security at a certain price by a certain time. So why is it represented by a bull? Because if you are an investor who says, okay, I believe in, again, I use example Apple. If I believe in this company called Apple, I believe that Apple is poised in a good position to ride on the 5G. It is a company that is under the solid stewardship of the current CEO, Tim Cook. The company is always at the forefront of pushing out new products and is always very attuned to consumer needs and so on. So you are very confident, you're very bullish about the stock price of Apple. You think that Apple's stock price is poised to continue to increase in the future. So you can essentially enter into a call option contract that gives you the right to buy this share. Let's say yesterday Apple share was at 170, it closed about 117, $118 per share. So you can, let's just say as an example, the call option gives you the right to buy Apple shares, let's say 30 days from today at $100. You think $100 is a fair value, and you want to enter into a call option contract to say, I want to have the right to buy Apple shares 30 days from today at $100. So that's why it's represented by a bull, because it's usually used by someone who has a bullish outlook about an underlying stock like or security like Apple. Puts, on the other hand, I use a bear to explain what is a put. If you're bearish about a particular stock, let's just say, if you're not confident that let's just say for example sake, Coca-Cola, because if you have your own reasons for saying that I'm not very confident that Coca-Cola stock price will continue to increase because of whatever reasons, you can actually enter into a put contract that gives you the right to sell your Coca-Cola stocks at a certain date at a certain price. So if you think that Coke shares at the end of the year is going to drop based on whatever reasons that you have, you can actually enter into a put option contract that says, even if the price of Coke drops to below below the price of the stocks that you bought the Cokes at. Let's just say, for example, you bought Coke at $30. Let's just say 6 months ago you bought Coke at $30, and right, that gives you the right to sell Coke shares at, let's say, $32 at end of the year. Even though the price has dropped, you enter into this put option contract where you say, even the price drop, I still can sell my Coke stock at $32. So it gives you the protection and it still guarantees you a certain level of capital gains. So that's how call and put contracts are. And just to give you a tip of how you remember what's a call, what's a put. Think of a call as a buy, like calling up a friend. You can call the stock away from the person who sold the contract to you. I can call away the Apple stock from your counterparty, right? A put is to sell. Putting down, let's say put down your money and you walk away. You put down your asset to the person, your counterparty. So if you are, again, I use the example of Coca-Cola stocks. You want to put it down to the person, your counterparty, because you want to offload, you want to rebalance the portfolio for whatever reason. So that's how you can actually use this memory tip of call and put. I'd like to do a sanity check. At this point in time, is everybody on the same page as me? If everybody is okay, any questions? Okay, we have a question from Bill Lee, right? Why don't you just buy the share and wait for 30 days? Now, can you guarantee that it is a good question? Can you guarantee that 30 days from now, even though you think the stock will go up, but can you guarantee that 30 days from now the stock will guarantee go up? You can't. In fact, I've read based on some literature that the probability of a stock actually going up based on some research is that this is only 20% of stocks that you buy actually appreciates, meaning to say that there's only a 1 in 5 chance that when you buy the stock that the stock price will actually appreciate. So there's no guarantee. The short answer is there's no guarantee that if you buy the stock outright and wait for 30 days for the share price to go up, because you cannot guarantee that the stock price will definitely go up 30 days from now. Yes, you can. If you decide to buy the stock outright, you can do that, but there's no way for yourself to guarantee, to be very sure that by buying the stock outright, the share price will actually go up. Later on, I'll show you that this is where using options come in, where you can actually buy the stock at a much lower price, and even if the underlying stock doesn't increase, doesn't appreciate, you have actually entered at an effectively lower price, which means that if when the time does come for you to sell, your gains are actually your ROI can actually be much bigger. So Bill, I hope I've been able to answer your question. So 2 types of options that I said, call and put. There are 4 ways to trade. You can be a buyer, you can be a seller. So what does it mean to be a buyer? When you buy a call, remember now, just let me recap again. A call is depicted by the bull, right? The bull image. That means you are somewhat bullish. A put is depicted by the bear. Now, if you're a call buyer, that means you as a buyer, what does a buyer do? Buyer pay money, right? When you pay money, you kind of talk louder, all right? You can talk louder than the seller because I pay money, what? So I have. Now the terminology, we all need to be clear about the terminology. As a buyer, you have the right. As a seller, you will have an obligation, because as a seller, what happens? As a seller, you collect money, means you're obligated already. You need to deliver on your contractual agreement. As a buyer, I have the right, but not the obligation to buy from my counterparty. The right means that if I enter into contract, the contract says that I can buy Apple shares from you 30 days from today at let's just say $100. today's Apple, yesterday Apple closed at 117 something, right? So let's say 30 to yeah, under the contract, 30 days later, I have the right to buy. But if let's say Apple shares drop to $90, it'll be silly for me to go actually say that I still continue to go through the contract and buy from you at $100 when I can actually go into the open market and buy at $90, right? So my outlay will be smaller and I get the Apple stock at a cheaper price rather than going to. So as a call buyer, you actually have the right to, but not the obligation. That means if you choose on the expiry date, on the day the contract needs to be fulfilled, you choose that, okay, I decide not to follow through and decide not to conclude the option contract. I have the right to do so. But also what happens to me, of course, there are implications. The implication is the money I paid, I will lose it. You know, your counterparty who collected the money as a form of penalty on my part, he gets to keep because in a sense, I chose not to fulfill my side of the obligation, so of the contract. So your counterparty will get to keep whatever money I paid. So that is the beauty and flexibility of having a option. So a question from Bill again: is it 30 days later I can exercise anytime? So an option allows you to exercise in theory anytime during this period. Yes. So you don't really have to wait until for the full 30 days. And another answer to your question, why not just wait for 30 days later, is if you recall the example I said, if the stock price of Apple drops to $90, you can actually go into the open market and buy at a lower price. So you don't really need to fork out that much money, and in a sense you also get a better deal because you save on your capital outlay. Instead of paying $100 per share, you are actually now able to pay at $90. So going back to this 4 ways to trade, you can be a buyer, you can be a seller. As a seller, you collect money means that the onus is on you to you have a bigger onus. You have a bigger onus to fulfill your side of the contract. You are obliged to fulfill. If your contract states that you have to sell the stock to the call buyer, if let's say the stock has run up from $150, the call buyer has the right to say, okay, I want to exercise. I want you to sell the Apple shares to me now at our agreed contract price of $100. So in that sense, the call buyer will be the one who benefits, who can potentially enjoy the capital gains. The call seller will suck thumb and say, because I collected money from you already, I am obligated to sell to you at $100. Even though today in the open market, Apple shares are traded at 150, but I cannot sell my Apple shares in the open market for 150. I can no longer do that because I have an obligation to sell to you at 100. That was the contract we agreed in. So puts, what about puts? Same thing. If you're a buyer, you have bigger power in that sense. You have the right but not an obligation. You have the right to sell the stock at the price that you agree with your counterparty, the put seller. So if you remember the Coca-Cola example, let's say Coke stock is, let's just say hypothetically, is $30. You buy a put that gives you the right to sell at $32, even though the Coke price may drop. Okay, but of course, if the Coke price in the open market rises up to $40, then you have the right to say, okay, I don't want to go through with this option contract anymore. I want to just go into open market and sell my Coke shares and get even bigger profits. You can do that. But as a put seller, if the price of Coca-Cola drops to below the price of what your counterparty has entered in the contract. So let's just say if I'm a put buyer, I buy this put option from you, from the seller. Even if the price of Coke drops to $25, I am obliged to, you as a put seller, you're obliged to buy my Coke's shares at the agreed contract value of, let's say, $32, for example. So that's how options, in a sense, in the very broad sense, work. Let me go to the next slide. I'd like to do a sanity check again. Everybody okay? Is everybody okay? If everybody is okay, just type in the chat box. Give me a thumbs up. Okay. Any questions? Just put it. If everybody is okay so far following me, then what I'll do is I will continue. Miron. Thank you, Bill. Thank you for the feedback. Now, as I said, options is really a lot about knowing where you stand. What is which side of the contract are you on? Are you on the buyer side? Are you on the seller side? As I said, to explain in very layperson terms, as a buyer, you can talk louder. Okay, your voice also louder. As a seller, okay, you suck thumb, in a sense you suck thumb, but as a seller, you have advantages of a seller. Selling means what? You get money, right? So let me just state very clearly. My options strategies, the way I earn my regular income is because I take the position of a seller more often than I take the position of a buyer. So selling has its advantages too. Okay. So, but I need to be aware of what are my obligations as a seller. So if I'm someone who sells a lot of puts to generate the monthly income, I need to be prepared to buy the stock if the trade goes against me or if I get exercise. That means to say that if the underlying share price of the stock goes below the contractual price agreement that I enter into, that means the put buyer has the right to sell to me at this price, even though the price of the stock has dropped to below a certain threshold. As a seller, I need to be mindful and I need to fork out the money to buy the stock from the put buyer. So there are risks involved from both sides of the house. As a buyer, because you pay money, right? If you decide, because you have the right, you can decide not to continue with the transaction, with the contract. If you decide to walk away, there's still risk for you. That means the money that you pay, you cannot claw back. The money becomes your counterparties, right? So there's still a risk for you as a buyer, even though you can talk louder, but the risk is that the price you paid is you are not going to get back. The risk is the price you pay for the option. The risk as a seller is if when I wrote there as potentially unlimited, and that is because if the stock price, depending on the option strategy that you use, if the stock price keep on dropping, which this one I will share later in the risk trade-off figures. If the stock price keep on dropping, there are situations where your risk is potentially unlimited. So for example, why your risk is potentially unlimited, actually technically it's not say unlimited, it's your risk is the maximum loss of the stock. Let's just say theoretically, okay, Coca-Cola stock, the Coca-Cola company goes bankrupt, the stock drops to zero. Theoretically possible, but hypothetically but highly improbable, right? So if the stock price drops, the company goes bankrupt, the stock price drops to zero. As a seller, I'm still obliged to buy the Coca-Cola stock at $32 based on the contractual agreement that I enter into with the put buyer. So that is what I mean by risks as potentially unlimited, or maximum loss. I can actually be facing maximum loss in terms of the stock going down to practically worthless. So just as a quick summary, as a call buyer, you have the right but not obligation to buy. As a call seller, you are obliged to sell the stocks. So this is where the concept of naked comes in. Okay, if you're someone who what Amy means by naked, when you are you do not actually own any stock of Apple, but you can actually enter into options contract without actually owning any stock. But this is where the naked, if you are selling naked, this becomes very risky for you. If you enter into a naked, if you are a naked call seller, that means if the trade goes against you, you are obliged to go out into the market to actually buy the stock at the market price, and then fulfill your agreement by selling the stock at a lower price to the call buyer. So this is very dangerous. Let me just share a real case. I have been burnt before as a naked seller, as a naked call seller. I sold Tesla stocks naked. I sold Tesla call options naked. When Tesla was going up, was trading in the region of 400 plus, 500 plus, then there was in October last year, it shot up to about 900 plus 1,000. I sold some naked call options at $700 over dollars for at the contract price 700. The Tesla stock shot up to 900 plus, so I had to go into the open market and buy Tesla stocks at 900 over dollars in order to sell it to the call buyer at 700. So I within that 1-2 days or 1-2 nights, I lost 50 over thousand US dollars. No joke, damn painful. Okay, so you need to be mindful as an options trader. If you invest in options, you need to be mindful of engaging in naked trades. Does it mean naked is all bad? No, naked need not be all bad, because I do a fair bit of naked puts, sell puts. I sell quite a fair bit of naked puts, because I go in with my eyes open. I do it with my eyes open because I do it only on stocks that I feel are good company stocks that I don't mind owning if I get exercise. So if the trade goes against me, fine. What happens? I just make sure I have enough money to fork out and buy the stock. I don't mind owning the stock. So do I mind owning the stocks like Apple? Do I mind owning stocks like Nvidia or AMD? No, I don't. So if I sell naked puts, what happens is I collect money. The money becomes my recurring income, right? So, but if the stock price of Apple really drops and I'm obliged to buy from my counterparty, then I just make sure I have enough money to actually buy. And in a sense, it's also good for me because it means that I'm actually buying the underlying stock at a much lower price than compared to if I'm buying the stock outright from the stock market today at 100. Apple stock, as I said, is $117 something yesterday night, right? So instead of buying at 117, maybe three months, a month later, 30 days from now, if the stock price drops to $100, and because I'm obliged to buy at $100, if it drops to $100 or below, I'm obliged to buy them. I buy them because it allows me to then buy the stock at $100 30 days from now, which is better than buying at 117, right? So let me just go to the chat again. From Bill again, wouldn't the chance of this happening quite often? The market is so volatile. Yes, the market is quite volatile in recent times, especially given the US is in a state of flux now with the looming presidential election, and we are in the midst of the earnings seasons. So it does create a lot more volatility in the marketplace. So one way to mitigate this volatility is to focus on either very, very good company, very strong companies, or okay, let me also qualify that. When you focus on good company, it doesn't mean that there's no volatility. You just have to be prepared to weather the volatility, or you can just invest in maybe in indices like S&P 500, SPY. The stock ticker is SPY. So there are some or maybe using option strats. There are some option strats that actually allow you to buy and sell in the same transaction that has a protective layer. So I will talk about that in a short while. So KY, cash secured put. Cash secured put. Cash secured put it in. Okay, I will take it to mean that you have the money to actually buy the stock if you get exercise. Yes. So in that context, yes. In any case, the trading platform I use will also require to put in a minimum amount of capital so that you actually have the money to be able to pay for the stocks if you get excited and you need to actually buy the stock. So in that sense, yes, you need to have sufficient cash to be able to buy the stock if you get exercise. Bill, again, unpredictable, like Tesla's earning went up. Yes, so that's the reason why I said that in recent times, given the upcoming presidential election and we are in the midst of earnings season, one of the risk management is measures that I advocate is during this time, if you know that there are certain stocks that are due to report earnings, do not enter into options contract or trade the stock that is going to report earning, and wait until the company is reported earnings, until the earnings report is over, then you consider entering. So that's some of my risk management measures that I adopt given the current state of volatility. So again, just as a recap, what is this last point spells out very clearly what is the right obligation of a put buyer and the put seller. So